Constructing a major bridge or a national rail network requires billions of dollars in capital, amounts that exceed the limits of standard bank loans. To raise that scale of funding, governments and corporations turn to the public markets and issue a conventional bond. For centuries, this has operated as a legally binding IOU, a promise to repay borrowed capital at a later date. A bond's face value, or par value, is the exact amount owed at maturity. Issuers also pay a coupon rate, steady interest cash flows. Zero-coupon bonds are exceptions. Paying no periodic interest, they're sold at a steep discount, relying entirely on capital gains at maturity. This system allows for efficient global financing, but the entire mechanism depends on one specific requirement: trading debt for fixed interest. A vast portion of global wealth operates under Sharia, or Islamic law, which strictly forbids riba, the act of making money from money. In this system, charging or earning interest is prohibited. The only recognized loan in Islamic finance is Qard al-Hasan. This is a benevolent loan, meaning the borrower has no obligation to pay any financial return on top of the principal. If debt and interest are off the table, how can these investors participate in the global capital markets? Financial engineers bypassed the debt model by creating the sukuk, an investment certificate with a strict requirement. The funds raised cannot be used for general corporate needs. They must finance specific, tangible assets. This diagram shows how returns differ. Conventional bonds guarantee fixed interest. Sukuk returns are generated exclusively by the asset's actual cash flows. This link changes the investor's legal status. They participate as hybrid owners, holding a direct right to those cash flows. Several Sharia contracts make this possible. Ijara structures the deal as a lease-based transaction, while murabaha uses a profit markup sale, purchasing an asset and reselling it at a defined margin. The sukuk replaces speculative debt with physical ownership, ensuring the financial instrument is tied directly to the performance of the real economy. Two structural models manage risk. In asset-backed structures, the asset is sold to a special purpose vehicle. The SPV holds ownership, providing real collateral. Asset-based structures keep ownership with the issuer, leaving investments unsecured. Lacking collateral, investors require higher yields for the risk. This system relies on a network of specialists. The originator raises the capital, the trustee manages the SPV to protect investor rights, and rating agencies monitor the credit risk of the underlying assets. Final oversight falls to Sharia advisors. They vet the entire structure to ensure that every contract and cash flow remains compliant with Islamic law. This multi-layered ecosystem creates a financial instrument that is rigorously audited and inferred to real economic activity. Today, these parallel markets operate side by side, moving billions through the global economy daily in financial hubs like Kuala Lumpur. Historically, the complexity and high minimum entry costs of both conventional bonds and sukuk restricted them to governments, massive banks, and institutional billionaires. That changed in August 2020 with the launch of the Sukuk Prihatin, Malaysia's first fully digital sukuk. By utilizing digital platforms like JomPay and DuitNow, the government allowed everyday citizens to subscribe directly for a micro-investment of just 500 ringgit. This specific instrument raised $500 million ringgit to fund post-COVID-19 economic recovery, aiding affected individuals and rebuilding local infrastructure. Digital asset-backed instruments now integrate the everyday investor into the real economy, replacing the exclusive trade of paper debt with accessible ownership.